got midterm, we got short term, we got intermediate term, we got 3 month, and then we got midterm volatility. I call that longer term volatility, 4 months. Okay, so the point of this is that we can see numbers are rising as we go out in time, and that is considered a normalized term structure, normalized curve of volatility. Okay, much like when you look at bonds or you look at commodities that are in contango, all right, we have a normalized curve, which means that you should be paying more for volatility out in the future than you are paying now. Okay, if you're paying up for current volatility more than you are tomorrow's volatility, that's a problem, because the marketplace is expecting extension of downside or volatility in the short term. Okay, does that make sense? Much like when you buy a bond, if you lend your money out for a longer period of time, okay, you should expect a greater return. Correct? You should expect more money on your investment, more of a return than you are for a shorter term investment. So if you lend your money out for 90 days, or a year, or 5 years, or 10 years, you should be getting a better return as you go longer out on the risk curve. The risk curve, or the opportunity risk curve, is going to be much more expensive as you go out. Okay, if that is indeed different, that creates lots of issues or lots of problems, and actually that defines structural problems within the economy going forward. In fact, if you look back in history, back in 2000 or even back in 2006 or 2007, we saw the yield curve on bonds inverted, which kind of portrays that the fact that recession is coming, which kind of buys into my next argument over here. The fact that there are some people out there who believe that we are not only in a recession now, but we are going to be heading into a bigger recession down the road. I just don't see it happening, and the bond market will tell you the same thing, that it's not necessarily happening. In fact, possibly quite the opposite is occurring. We're not heading into a recession. We have some sort of weird low growth without very much inflation at all in the economy. Now, you may argue with me on that. Prices rising in certain areas. I can kind of concur with you on that. But the point of the matter is that if the Fed is not seeing the inflation coming on the horizon, then that's really the operative point right there. If the Fed is not seeing it, then they're not going to make any moves to jiggle Fed policy. Does that make sense?